Hey everyone, and welcome to another edition of the Quantum Mailbag. In this video, we're going to talk about some of the really fundamental basics behind market making that help you better understand the things that go into market making in an equity options environment. Now, in this video, we're going to talk about super basic stuff that really doesn't have to do with investing, but it underpins the things that go on that can help you answer a couple of the key questions that come up a lot in our day-to-day. The first one is people ask us all the time, how do I find options or trades with positive expected value? And what they're really asking is, how do I find a trade where the person on the other side of that trade is willing to give me an edge? In other words, they're basically willing to take on the risk that I'm probably going to make more money on the trade than they do. And as you can imagine, the theoretical answer to that is that you'll never get one of those trades because nobody would ever take the other side of it. Now, from a practical perspective, there are obviously cases where that does happen. For example, on a closing options expiration day, when you're looking to close out an option, you might pay 1 cent to close out an option that's otherwise worthless, right? So it's like there's things like that that come up. But in the course of typical investing, there are cases where the market makers will give up an edge because it's in their own best interest. And we're going to talk about that today. We're going to talk about when the market makers give up an edge and why. And we're going to use a super simple scenario. We're not going to get into anything that has to do with finance. This is simply going to be about tossing a coin, because it's well understood a coin is 50-50, right? You flip a coin, it comes up heads, it comes up tails. If you did it a million times, the expected value is going to be half heads, half tails. So anybody who wants to place a bet on one side or the other would expect to get a 50-50 result. Now, of course, if you're going to make a market in that, you're not going to ask for 50 cents for a $1 bet, right? Because then you would never make any money. There'd be no real incentive in it for you. So let's talk a little bit about making a book. And we're literally gonna make a book here. So I'm gonna open up Excel here. And I'm gonna start here with these two columns. We're gonna make this real simple. We're gonna have a heads column and we're gonna have a tails column. And what these heads and tails columns represent is the value of bets that we've received. Now, let's say as a market maker, we decide that we're going to accept bets at 52 cents per. So we get one bet for heads at 52 cents, and we get another bet at heads at tails at 52 cents, which simply means they're paying us 52 cents. And then when that coin toss happens, if it comes up heads, they get $1 if they bet on heads. If they bet on tails, then they would get nothing because their bet would be worthless. And let's assume there's going to be one event that happens. There's going to be one coin toss after all the bets have been collected, and then the outcome of that will decide how all the bets are settled. So we just have this very simple thing, and we're using Excel here. So I have a book here with two bets in it, one for heads, one for tails. They both paid 52 cents. Now let's actually organize the book. This was just a ledger of the bets that we've received, and it's laid out for simplicity in the model it is. But let's say we want to actually make a book to manage this, right? So we're going to have a side where we track our heads and our tails. So we'll say heads and tails. And then we're also going to have, in this case, we'll want to know, let's say, the number of bets that we've collected. We also want to know, I would say, the total amount that's received and the liability. So we'll say the amount we've collected, and then we'll say the liability. So the amount we've collected is the total amount that people have paid for those bets. And the liability is how much it'll cost if that bet goes against us. And then finally, we're going to care about what the net result is. So we've got our heads and our tails, and we'll also have a totals column down here, right? Just because it'll make the math a little bit easier in Excel. So the bets is simply going to be the sum of everything in the heads column, right? So this is going to tell us how many bets were placed on, the count, not the sum. So the count of how many bets were placed on heads, and then this is going to be the count of how many bets were placed on tails. So simple enough. Now we're also going to say for the amount collected, that's going to be the sum, right? That's going to be the sum of all the bets that we got on heads. And this will be the sum of all the bets we got on tails. There's probably a shortcut way to do this, but whatever. Now the liability is actually really easy because the liability simply is, in this case, it's going to be the number of bets that we've received, because it's $1 that we're liable per bet if it comes through in favor of that person. So we've got, in this case, in the event that it comes up heads, we're going to owe $1. And if it comes up tails, we're also going to owe $1. And so what we care about here is like really the sum of what we've collected. So if we just say this is the sum of these two columns, then we've collected $1 for. So our net result is going to be the amount we've collected less the amount of the liability. And the same is going to be the case here. The amount we've collected less the sum of our liabilities. So it's kind of cool here, right? Because what we're noticing here is that we have an expected value of 4 cents, regardless of which way it wins, because we took one bet on each side. And so we'll go ahead and I'm going to do a little conditional formatting here just to make this easier to follow. And we'll say that's probably the one I want. So they're green, which is great. But let's say word gets out that heads is hot, and very likely to be heads. And so because we've got our standing bet for like all these heads, what we're looking at here is a scenario where we've now got 5 bets that came in where we collected $2.60, and we have a liability for $5, which means that even if you combine this, right, we've only collected $3.12 across the 6 bets, which means that if it does come up heads, we lose here. Now, we can hope that tails is going to get a bunch of money coming in on it, but realistically, it's probably not, because if for whatever reason people are betting on heads, there's some kind of belief out there that the coin is fixed or the take is in, or who knows. So they're all kind of putting their money on heads. So as the market maker here, right, what I probably want to do is I want to say, well, I really want money on tails, because my goal here is to balance out the bets on each side of my book. So I might be willing to go down to 49 cents. So if I come into 49 cents and I say, how many of these bets do I need to fulfill? Well, it turns out as soon as I get to, let's say, an equal number of bets on this side, so I now have 5 bets here, I've got myself in a situation where I've now broken out, where I've gotten to somewhat of an arbitrage again, where now I'm guaranteed this 8 cents regardless of which way the trade turns out, or which way the coin toss turns out. And so what I've done here is I've actually accepted 10 total bets. 4 of those bets I've given up edge on, but I've given up edge because it helps me guarantee the fact that I'm going to make money on this. Now, as the numbers get bigger, right, if we had a whole bunch of people that were taking this, in addition, actually what I should say, what would also happen very likely at this point is as I take on more money on the head side, what I might do simultaneously is I might require the bets to be larger. Like I might move it up substantially and say, hey, I've got so much money on this side that I'm going to take more. And this way I can, it won't take nearly as much for me to get to the point where I can start to expect to make money by expecting more money here. And I could even lower this down. I mean, I could say as I get more desperate, closer to that date, I could lower the amount of money that I'm accepting just to get money on that side. So we're seeing like lower and lower bet values come in just because I'm trying to keep things balanced. And what would otherwise be a 50-50 trade, you can now get an edge on by simply saying, I think that, I'll take the 53% chance, or I'll take a payoff where I'm basically buying a 50% chance that something's going to happen for the price of a 47% chance. And so this is kind of the fundamentals of market making, only in the case of this being a coin toss where it's 50-50, in an equity options environment, it's way more complex. I mean, in options and futures, etc., like everything like that is more complex for a variety of reasons. But one of the things that's important to understand is that when you're dealing with this and you're making options trades on a given underlying, that stuff's always moving. Obviously, rates move a little bit, but the underlying price moves a lot. And so what you see with stocks is that instead of them watching necessarily the amount of money they've collected, what they'll often look at is the money they've collected, but they also care about delta, because they want to know if the stock moves a lot in one direction or another. Their goal is to be able to consolidate around a certain point where that delta is as low as possible, because it represents as little liability for them for movement in the underlying stock. In addition, when you're dealing with options trading, the market makers will also have the ability to offload trades. So in this case, when we did these heads and tails bets here, the heads and tails bets is sort of like going long or short a given option. So if we wanted to make a market out of the coin toss, what we would really do is we'd say like somebody would be able to buy an option for the toss coming up heads, and therefore selling the option would be like taking tails. So it's sort of, again, 2 sides to the same coin, which is how the options world really lives, except the calls and puts are fundamentally different, although obviously related, but they're fundamentally different types of options. So keeping that in mind, if you had more sophisticated ways of dealing with the different other outcomes that could come into play that wasn't so binary as the coin toss is, there'd be other ways for you to hedge your book as a market maker. But the key focus here is that there are times when you can get an edge, which is why you sometimes see volatilities that are a little out of whack, or you see prices that seem to be in favor of you placing an investment in one direction or another. This often comes up, for example, when you have stocks that are hard to borrow, where you see the implied volatility go up drastically for puts and down for calls, because the market pressure is to push a stock down substantially. And when that market pressure is there to push the stock down, people turn to options and they start trying to buy puts and sell calls in order to finance and to express that bearish sentiment they have. The market makers at the same time are saying that they're holding on to all these short put and long call positions. They become very willing to buy puts from you and sell calls to you because they're trying to get out of the lopsided books that they have. And so you get things like the synthetic long discounts, as we call them in Quantcha, where you're able to go out and open a long position with a delta 1 by selling a put and buying a call in a stock that's all beaten down and people are very bearish on, and you'll often get it at a discount of 10% or greater. So like a stock trading at $100, you can buy that long position for the equivalent of what would be $90. The downside being that the entire market seems to be against you to the extreme level where the market makers are almost paying you to take edge. So just keep that in mind before making any moves there. But as always, if you have any questions and other things that you are interested in, we're always collecting over at the Quantcha Mailbag. Please hit us up at hello@quantcha.com. And as always, good luck and good hunting.